welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, are you a retiree, or you probably have retired parents at home? And generally, all of us are in some way or the other grappling with falling interest rates and rising inflation. So to help us deal with this situation better, I'm joined by CEO Value Research, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Today's episode is meant to share some tips specifically with retirees to help them optimize returns and beat inflation, but I'm sure all of us can learn and implement them. So, tell us, Dhirendra, how should one get started?
First and foremost, reduce your tax bill as much as possible. Tax saved is money earned, and more so, it is it's a big help in your retirement. So what you can do, one is that you get a tax break on up to 50,000 rupee contributed towards health insurance. So you need health insurance, and the premium paid for that is a deductible expense. It is not. It is taken as an. It's not thought of as a income if you have income coming from any source. So that's one. Take it to the hilt. The other is, you have to even in retirement, people think that you become a little careless. Plan your taxes better. So maybe if you have your capital which is invested, but you are paying some tax, use all the available breaks under ATC to the hilt, which is 1.5 lakh rupees. Even if you have some money invested, take it out, invest it again. This 1.5 lakh rupee investment will translate into reduction of your income by 1.5 lakh rupee for computing taxes. So that is quite meaningful. That can actually take up, my sense is that if retirees have an income from all sources, if they have an income of 7.5 lakh rupees a year, things can be done in such a manner that their tax bill can actually be reduced to, they may not have to pay any tax.
Okay, and what about optimizing the returns? Specifically at a time when the returns from both debt funds and fixed deposits have fallen?
You don't have too many options here, but what I understand from all the questions, and we get plenty of questions on this aspect because people are really getting worried and they have seen their income falling. A lot of people, the returns, we think that, okay, interest rate has come down from 9% to 6% over the last 5-7 years. It might look like, okay, 3%, but it is not 3%. If you are a retired person, you are earning 100 rupees. This reduction is actually 1/3 reduction in your income. If you had 1 crore of rupees and if you are making 9 lakh rupees a year, and now your income is 6 lakh rupees, imagine inflation is going up and your income is coming down. So that is why it is very important to find first what I said, that save taxes, avoid, reduce your tax bill. Then comes where can you maximize return. At the same time, you have to worry about, you get worried if you can't take undue risk, and you have to get used to, you need some coaching. You need to understand that what is risk and what is avoidable risk, what is a risk which is worth embracing, which is worth assuming, and which is a risk, which risk you should avoid at any cost. And my sense is that people have to embrace equity in some manner, unless you have plenty of money and you don't bother. Because
one of the highest return that you can get in India from fixed income instrument is 7.15%, and that it's also the hub with highest safety, the Government of India bond.
And 7.15%, but it will be a taxable income. If you have 1 crore of rupees and if you are getting 7 lakh, 15,000 rupees a year, then it will come to a point where if you will make the tax saving investment, then you can reduce your bill. Otherwise, it will be taxable. So I think if you are completely risk averse, you will have to reconcile with less income. Not only that, my real worry is that if you don't invest in equity, and assuming that you are able to manage your affairs from the current income of your fixed income investment, you will become poorer in 5 years' time because your capital will remain constant. So without investing in equity, you can't do that.
Now, I've seen many people opting for the dividend plan of mutual fund schemes to derive regular income. But do you think that's a good strategy?
No, this is investors shouldn't be doing it. And why they do it is quite understandable. It is very deeply embedded uh, in our thinking that if you are getting dividend, then your investment is performing well, and dividend is being looked upon as if it is an interest income coming from a deposit. People still relate to any investment like a deposit, and dividend coming back to you looks like your investment is performing, and this is the reward of the productivity of your investment. That is not necessarily true in case of mutual fund, because mutual fund you can take any time a part of your money back, and because in deposit you have the coupon which is paid at a defined periodicity, annually, semi-annually, quarterly, monthly, whatever you choose to, or the design of the instrument. In case of mutual fund, you get a dividend, or the fund company pays a dividend. The moment it pays a dividend, your NAV, which is realizable anytime, gets reduced exactly by the same amount, assuming that in the worth of your investment, if a fund's NAV is something like 20 rupee, and the fund chooses to give you something like 10,000 rupees, and your total investment in that fund is worth a lakh of rupees, and the fund chooses to give you 10,000 rupees dividend. The day you get 10,000 rupees, your investment worth will get reduced to 90,000 rupees. So it is just a matter of, either you hold your investment. I think why people should not have, choose dividend plan for two reasons. One is that you should choose the time when you need the money. You should choose to withdraw a small part of your money depending on your need and depending on the time when you need it. You get dividend when the fund company chooses to give you. You will take money from a fund at a time of your choosing and a quantum of your choice. How much do you want to take? That is one. The other is that the tax treatment of dividend is that it will be treated as your income, and it will be taxed accordingly. Whereas when you do a systematic withdrawal plan, and this is a feature which is possible because mutual fund provide you phenomenal liquidity. You can take all your money out anytime, or you can take a small amount all the time, at a regular periodicity, and you can choose the periodicity, you can choose the amount. You can invest a lakh of rupees, and you can choose to have 1,000 rupees every month on 15th of every month, and the money will come back to you. It is almost like a standing instruction that you give in a bank. And when you do this withdrawal, it is more tax efficient because it is considered not as your income, but a withdrawal. And in the initial years, even if it will be treated as your income, a small part of it is gain. Large part of it is, getting your money back, while all your money is growing. So tax efficiency and, choice of your time and amount makes it, important that you don't choose dividend plans. And that is why, and SEBI understood this. This is a behavioral quirk which everybody was trapped into. So now mutual fund, just to hammer this idea that dividend is not what you think it is. That is why the name of the dividend has been mandated by the law, by the regulator of mutual funds. They are not called dividends anymore.
Yeah, so all right, a big no to dividend plans. But then,
Yes.
how should one derive regular income for the living expenses if someone doesn't have a pension or any other source? Are fixed deposit the only choice in that case?
No, fixed deposit is one thing. You invest, say, a amount, and you get the coupon on that. And when it is due for renewal, you will get the you will get the interest on that deposit thereafter. And the tax treatment of this income on your deposit is treated as your income. Interest income is taxable. It is as your income. So if all your interest income adds up to less than the tax bracket, it is tax free for you because you are not liable to pay taxes. But that may not be the situation. So interest income is taxable. What happens is when you invest in, and I come across a lot of people who do not require income from their investment, but they are risk averse. They want a good part of their money to be in fixed income simply because they are not used to the market risk, or they have chosen to have a certain part of their money in fixed income all the time, assuming that you have a lot of money, but still you don't want to put all your money into equity. You just put half of your money into equity and half of the money in fixed income, and your fixed income investment is also long-term investment. In that case, if you do a deposit, the annual interest generated on that deposit will be taxable, and you don't need that income. So for those people, I think mutual funds really solve a big problem. In mutual fund, when you invest in a debt fund, you can, and you have various kind of debt fund. There are debt funds which are almost risk free. There are debt funds which are low risk, and then there are risky debt funds which endeavor to give you higher return, and you can also lose money sometimes. So go for the lower risk funds, but when you invest in a debt fund as compared to a deposit, till the time you don't do anything about it, till the time you don't realize any part of it, you are not liable to pay taxes. So if you invest in a debt fund and you invest a lakh of rupees, and in 10 years time it becomes 5 lakh, 2 lakh rupees, assuming, or 8 years it becomes 2 lakh rupees. You are not liable to pay taxes unless you sell a part of it. So this, I think, is a very less appreciated benefit of investing in a debt fund. Because and besides that, you have high liquidity. You can take your money out, because in case of deposits, you put your money and you have to really get stuck to the term of the, ideally you should hold it for the term of the deposit, or there could be, your interest gets reduced if you take a premature encashment. In case of debt fund, there is no such thing. You are at liberty to take your money out, or a part of it, or whole of it, anytime.
And then there are also systematic withdrawal plans, right?
So I think this is a significant, benefit which can be derived from debt fund, that you can mount a systematic withdrawal plan. It is almost like a reverse of your recurring deposit. It is like you can choose to have, by investing in a debt fund, you can have it as a monthly income plan, or you can have it as a quarterly income plan. So if you invest 1 crore of rupees, and if you give a systematic withdrawal plan instruction of 50,000 rupee hitting your bank account every month, so 50,000 rupees worth of your units will be redeemed every month, and you'll get it. That, I think, is a far more efficient way of deriving your incomes, and need for your income will be supported greatly by this. And then you can invest your equity for the long term, a small part of it or large part of it, depending on how much guaranteed income or a fixed income is, not guaranteed but fixed income, that is required to support your income needs.
All right, time now to move on to our viewers' questions. And the first one comes in from Pranjal Gupta, who is 7 years away from retirement, and his superannuation fund is getting transferred to NPS. So it's a huge amount, and he wants to know how should he go about distributing the corpus between equity, corporate bonds, and government bonds.
For Pranjal, I don't think there is a straight formula. There isn't even a thumb rule, but I'll give you the basic framework which should guide anybody's allocation to transfer of any long-term money into your income, into your NPS account, because NPS has a design whereby you can have maximum 75% allocation to equity, and then remaining 25% can be distributed in any manner into, or it could be entirely into fixed income, and the fixed income choice is government bond or the corporate bonds. So my sense is that because I think the ideal thing will be, as he's referring, that it is a large sum of money, I think he should target some kind of allocation with the superannuation fund by his retirement. And at the time of his retirement, it is mandated. Of course, the rules of NPS is just about, it is being discussed that it will undergo a change. Because right now, when somebody retires and all your money in NPS, the maximum withdrawal that you can do from your NPS is 60%. Remaining 40% is to be used for buying annuity. But assuming that by that time everything changes and the rules are relaxed and you can do a SWP from your NPS plan, that is also something being discussed, or that is what I'm hearing from the policy people in the government. So if that happens, that is still 7 years away. Right now, I would think that he should only think in terms of having a target allocation to equity and debt. Maximum money should be, I think, right now, because you are 7 years away from that, assuming you are thinking of a target of 50% into equity, 50% into debt, have 75% into equity right now. remaining into fixed income. I will get to corporate debt and government in a moment, which is you invest 75%, allocate 75% to equity, 25% to fixed income, and choose to move 5%. In NPS there is also an auto plan. Don't go for that, because you will be exercising this discretion. 5 years before your retirement, reduce your 5%. Steadily decline, reduce your allocation to equity as you approach retirement, in a manner that at the time of retirement 50% of your money is in equity, 50% of your money is in debt. And this way you will also be in a position to do a very sharp rebalancing every year thereafter in your retirement. And maybe by in 7 years time, if it is possible to have your SWP, which can be done, if it is not possible, if it is not mandated, it is not compulsory to buy annuity for 40% of your accumulation, maybe you can mount a 8% annual withdrawal plan with a 50-50% allocation to equity and debt, and there is a great possibility that your money will keep growing, at the same time supporting your income. And by growth, it also means that you will have higher income in line with the inflation if you have this kind of allocation. I will give you the range of return that people have derived from equity and government bonds and the corporate bonds. The range of return of the 6-7 NPS plan providers from equity is in the region of 12 to 14.5, 15%, 12 to 15%, and it is difficult to guess. But you can choose the first one or two better ones. Likewise, the government plans are in the region of 8 to 8.5. It's a very narrow band. Government bonds plan, the funds, NPS funds have offered. Have generated this much of return, and the corporate bonds have funds have generated 8.5 to 9.25, and 8.5 to 9.25 is a little more. And because you will be investing, so I think a mix of corporate bonds and government bond is fine. Having 75% allocation to equity is good to begin with. Gradually reducing your equity annually, and that too after 2 years, maybe 5 years before your retirement, you start gradually reducing it in such a manner that it gets allocated in a manner of you are able to achieve an allocation of 50-50% into equity and debt. You can also looking at NPS plans, if you want to know more about them, their performance, how they have, kind of return they have generated. In fact, every publication in the country, or wherever you see the public disclosure of the performance of the NPS plan, including PFRDA, they use value research data, and you can also see it anytime. Just type valueresearchonline.com/NPS, and you will see the performance of all the plans. Not only these two plans available to you, you will also be, state government employees, central government employees, their plans performance is also available. So take a closer look at it. Maybe the NPS investors, because it is a mandatory investment, people haven't looked at the performance closely. Value research tracks the performance very closely. We are going to have more information on these NPS plans, and they are updated every day.
Now, 59-year-old Ashok Joshi is retired and wants to invest 50% of the accumulated corpus in fixed income funds to generate regular monthly and quarterly income. So out of banking and PSU, corporate bond and credit risk funds, which category of fixed income funds would you suggest for him?
So one is that the bad news is that any kind of funds, the return that he will see, he will not earn in the forthcoming, in recent future, because the past returns are way too impressive. It has also been a beneficiary of the rate cuts, which is reflected in the performance, because when interest rates go down, the bond funds appreciate. And the current performance, which you will see that last 1 year, last 3 years, last 5 years, the returns look very handsome. And when you invest with that expectation will not be met. Embrace for lower return from these funds. Looking at the safety and the relative experience of investors, I would say that more than, I think, banking PSU, if I have to really rank them in order of safety, I would say look at the banking and PSU fund, followed by corporate bond fund and the credit risk fund. in that order itself. But at the same time, just looking at these categories itself won't help. All these categories are filled with some good funds and some really bad funds. There are funds which have assumed uh, very bad risk or very undesirable risk, and they have suffered. And how to filter that is most important. So exercising your choice and being extremely selective in these categories is very important. It is not that the bad fund will actually give you a little lower return. In bad funds, you might lose money, and in good funds, you might get a decent return. So it is very important to exercise your choice carefully, be selective, and look at the rating exposure, the credit quality of the underlying portfolio, and how the fund has been careful. Also, try and choose funds, because we have been extremely conservative with our fixed income choices. Our analysts are, keeping an eye on all the categories. They're looking at these funds very closely, and look closely the analyst choice in the fixed income categories, and limit yourself to that. It is very, because fixed income investors are, fixed income investors simply because they are risk averse, and to generate a little more return, if you are putting your capital at stake, it is undesirable. And the other rule, which generally speaking every investor should follow, is that don't invest in the best performing fund on performance in recent times, because when a fund is assuming, when a fund is generating great return, it is a result of assuming some risk, and that, the penalty for that assuming that risk is so far not visible, but it can come to hit it anytime.
Hema Thakkar has just retired and she has about 1.5 crore rupees to invest and generate regular income. She has zero risk appetite and wants to generate 1.5 lakh rupees every month, at least for the next 25 years, she says. So where and how should she invest?
The bad news is, I find a lot of contradiction in the question. Not contradiction, I would say that I have constraints with this question, because one has 1.5 crore rupee, which is not by any standard, not a small sum of money. And the need is 1.5 lakh rupees a month. And also the statement is that one zero risk appetite. So the bad news, given these three things, that you have 1.5 crore rupee, you need 1.5 lakh rupees a month, which is 18 lakh rupees a year, and you have zero risk appetite. You don't want to assume any risk. One of the thing cannot be, it's not possible. Either you will get less return, or you will have to, assume some risk. Without that, it is not possible. And assuming some risk is accounting for, taking some chances. Let me just explain it to you, that what is that you can earn with zero risk. With zero risk, you can buy a Government of India bond, the floating rate bonds, and that too you will earn 7.15% now, but there is no guarantee that you will keep getting this return every year. And this 7.15% on your, 1.5 crore rupee will be about, about 10.75, or, about 11 crore rupees, assuming, roughly saying it is 11 crore rupee. And that 11 crore rupee will translate into, something like 92,000 rupees. I'm just doing it for ease of, it might be little bit here and there, but 11,000 rupee will be about 90, 91, 92,000 few hundred rupee, monthly return. So despite having 1.5 crore rupee, you can generate only this much. But that is not all. The real thing is that this money will not grow at all. This will generate now, but in 5 years' time, you will not need 1.5 lakh rupees. If you need 1.5 lakh rupees now, in 5 years' time, you just might need 2 lakh rupees a month. In 10 years, you just might need, about 3 lakh rupees or 2.5 lakh rupees. That money, that, the rising need, the need for rising income over a period of time to match with the inflation will not be met if you are completely risk averse. So this is something which has to be appreciated. You are not to be being risk averse is understandable, but being risk averse will actually make you look like, or you will be poor despite having so much money, which apparently looks like so much money, because your need is for a decent return, or your requirement is of a higher return, and your requirement, which you have not stated, is also of rising income, rising need over a period of time. So my sense is that with zero risk, your goals can't be achieved. You will have to assume a certain allocation to equity, and you will have to do it very carefully, and you will have to do it with an instrument. Of course, your money will be should substantially be into fixed income. It should substantially be into bond funds, these bonds, and other fixed income avenues for retirees. That can well be it can be anywhere between 50 to 75%. But I think a quarter of your money being in equity, you may not have a choice but to invest, and better get used to it quickly. Be very careful about it. Uh, Look for a good advisor, because it will require some degree of coaching, because you will be faced how to invest that money so that you can have a steady ride thereafter. You will not panic if you are because if you invest 25% of your money and the market falls dramatically soon after you invest, it can cause panic, and understandably so. How to get into the market and what to expect from it, and what is the nature of it, and what you should worry about, what you should not, is something which requires handholding.
Right. So Hema, even if you are risk averse for the kind of returns that you need, you will have to assume a little risk, is what Dhirendra is saying. Now, today's last question has been sent in by 40-year-old Chetan, who has 7 lakh rupees in his savings account as a contingency fund, and he wants to know where can he invest this amount to get better returns.
Ultra short-term bond fund, and maybe of this 7 lakh rupee, maybe 2 lakh rupee in money market. Sorry, the overnight funds. They are almost like money lying in your savings bank account. And there is a talk that this will be realizable on an almost instantaneously. So consider the overnight fund for a very small amount of money. And you can plan it better. You don't need an advisor. Your context should actually contribute to what is the kind of contingency which you can anticipate, and you must have that money. That could be 1 lakh, 2 lakh rupees, and then remaining 5 money is accessible on a 5-day basis. That should be in ultra short-term bond fund. So do your split, keep it in these 2 categories. And it is always good to have this contingency fund before you start making your long-term investment. That gives you peace of mind, and that makes you prepared. So I think term insurance, health insurance, term insurance if you have dependent, health insurance, and contingency fund is the basic foundation which anybody should have before, and that will really help you investing for the long run, and derive the most benefit out of these great sophisticated instruments or investments which have been made available to individual investors in India.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you, Ruchira.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.